I'm John Moog, Portfolio Manager of the Pengana Global Small Companies Fund. Our team's been investing in the small cap universe for the last 15 years, constructing high quality conviction portfolios in the small company space. Today I want to tell you a little bit about what we're seeing in the world and talk to you a little bit about how we're implementing that in our investment approach. In terms of how we invest, our focus is on investing in the highest quality businesses we can find in the space. We think that's the most important thing you can do to compound and protect capital when investing in small caps globally. We look for businesses with strong balance sheets, disciplined management teams, and governance that protects us as minority shareholders. And now I want to talk to you, I think the most important part about what I want to talk to you today is about what we see going on in the universe and the opportunities that we think that is facing the global small company space. Typically, small caps trade at a premium to large caps in terms of valuation. Today, however, that's not the case. Oftentimes in downturns, we see small caps sell off hardest, and that creates the opportunity for small caps to really outperform moving forward. We can see in times of crisis here that small caps actually get a bit cheaper than large caps. And today is one of those environments where small caps are trading at a discount to large caps. We think that creates a meaningful opportunity for small caps to outperform moving forward as we move into kind of a recovery phase for the global economy, and creates a meaningful opportunity for small caps to outperform large caps and create meaningful delta in performance. We also think it's been an interesting, unique period, and we're a period of inflection for global markets. With interest rates moving up, value investing is coming back in vogue. And this chart, I think, is an interesting one. This one highlights the performance of non-US versus US equities over a long period of time. The black line here shows when the black line here is going down, you can see US equities are outperforming non-US equities, and when the black line moves up, you see international non-US equities outperforming US equities. This is a 40-year view of the cycles here in non-US versus US. The brown line is an overlay of the US dollar strength. So it's a US dollar index against a basket of other currencies, and it's inverted. So when the brown line is going down, the US dollar is strengthening, and when the brown line is moving up, the US dollar is weakening. Over the last 40 years, you see a high correlation between US dollar strength and the outperformance of US stocks. And we think we're at an inflection point in that. Starting at about 2000, during the dot-com bubble, the US dollar bottomed against a basket of other currencies and then has topped out against a basket of other currencies, and then proceeded to weaken through the 2008 GFC. And you can see that international stocks outperformed dramatically during that period. Starting with the GFC in 2008, you saw the US dollar bottom out against a basket of other currencies and has strengthened for the last 14 years. During that time, you see non-US stocks underperforming US stocks pretty dramatically. We think we're now at an inflection as the dollar hit a 30-year high last year, has started to come off its highs, and we think higher interest rates could lead to a sustainably weaker US dollar, which could fuel non-US equities relative to US equities moving forward into a new investment cycle. Furthermore, the starting point of the valuations, I think, are supportive of this. If you look at valuations today, US equities are trading at about 18 times earnings, while equities around the rest of the world are trading anywhere between 11 and 13 times earnings. You see the disparity here has grown really meaningfully over the last 18 months as the US dollar and US assets have outperformed assets around the rest of the world quite meaningfully due to some of the macro concerns. But we think this creates a significant opportunity for reversion to the mean. Looking at the current macro environment, I think one thing that has surprised many is European stability in the back half of last year. We talk to about 300 to 500 management teams a year, and one thing that they constantly assured us of is that Europe was kind of muddling through Q3 and Q4 last year okay, and this macroeconomic data is supportive of that. Here we see PMI ticking down a bit in the back half of last year, but Europe is already back into its expansionary phase. With natural gas prices rolling over, we believe the expensive US dollar combined with cheaper natural gas will allow both Europe and Asia to potentially surprise on the upside with growth moving forward, as relatively cheaper labor costs will help drive manufacturing growth in Europe, and China reopening in Asia should help to drive growth throughout Asia in the coming quarters. To summarize, we see small caps being a better value to large caps today. Small caps are a cheaper multiple, grow faster, and earn higher returns over time than those large cap competitors, and we think today is an excellent time given the valuation discount that small caps are currently trading at. We also think it's an excellent time to be overweight non-US equities, given the significant valuation disparity, as well as more positive economic growth out of Europe and Asia. We also see the long-term potential for the US dollar retracing from its highs, helping fuel the returns of non-US equities. In the next 3 to 6 months, we would expect some short-term volatility as investors digest potentially higher interest rates, potentially slower growth, but we think this volatility will create excellent opportunities in the small cap space to continue building a position to look forward to great returns moving forward. The underperformance we've seen the last couple of years has really been driven by some of the factors that impact the companies we invest in. Namely, strong US dollar and large caps outperforming have impacted our performance. However, we're now getting into an environment where we would expect small cap value-based equities to perform quite well. With the weakening of the US dollar, with faster growth in Europe, it sets a very good environment for equity selection in the global small cap space. You've seen this in the last 6 months with our equities outperforming pretty meaningfully, and we would expect this environment to continue. Looking at the portfolio today, you can see the fund is overweight Western Europe, as well as overweight the small cap space. We think these are the areas where we can find the best value and the companies that are positioned really well to perform in this current environment, where we would expect small caps, value-based cash flow generating small caps to outperform very meaningfully. Now I want to give you a couple examples of the equities we're looking at and buying today. The first is Brembo. For those of you who don't know who Brembo is, they make high-end aluminum caliper brakes. They have a long tradition of making brakes for race cars, for high-end performance vehicles. Oftentimes the red and yellow brakes you see on Lamborghinis or Ferraris are Brembo brakes. They have over 85% market share in the aluminum caliper high-end brake niche. It's an excellent business that's family-owned. It's been growing for the last 20 years and will continue to grow given the prevalence of aluminum brakes. What makes aluminum brakes so important is that two characteristics. The first is that they're lighter. The second is that they're stronger. Again, Brembo has 85% market share and dominates this niche. What gets us excited here is we were buying this company at 11 times earnings, given some of the challenges in the auto supply chain. As we expect this to normalize, we would expect Brembo to continue to grow moving forward. However, the secular growth behind Brembo should be very appealing over the next 5 to 10 years. We've seen auto OEMs around the world invest heavily into their electric vehicle production. Electric vehicles have two traits that are very important for Brembo. The first is they're heavier than traditional internal combustion engine vehicles. The second is they're a lot faster. When you're making faster and heavier cars, what you need are stronger, lighter brakes. And Brembo is well positioned to capture meaningful market share in the electric vehicle market moving forward. We think this will drive a lot of high return growth, and we also are able to buy this company at an very attractive valuation. We think that's a potent combination for value creation moving forward. The next company I want to talk to you today about was Concentrix. Concentrix is in the customer relationship management business. Historically, we used to think about those as just simple call centers where we would call in and where consumers would call in with complaints or with questions about products. Today, it's a technology-led business with BPO outsourcing at the core of it, long-term customer relationships, sticky revenue, and very cash generative. We think this is an invaluable business in the customer relationship management space. There are only 7 players globally, and Concentrix is among the leaders. This business spun out from a larger business in the US, but lacks much institutional support, which is why we were able to buy it at 10 times cash earnings a couple of years ago. What's interesting about Concentrix is it's a business that grows high single digits with high returns and very consistent cash flows, exactly the type of business we want to invest in. Over the last 2 years, it's done nothing but deliver. And I think it's an interesting case study in what has happened in the back half of 2022. Concentrix itself, fundamentally, has never been stronger. However, the stock, even for a $7 billion US company with little institutional support, we see the stock sold off really meaningfully in the back half of last year. We took advantage of this and added to our position. But again, we think the opportunity to buy very high quality companies at meaningful discounts, given the sell-off that has occurred in many of these small to mid-cap companies around the world, is quite meaningful right now. And really what gets us excited about the current opportunity set. The last company I wanted to touch on today is InnoDisk. InnoDisk is a niche Taiwanese flash memory producer. For those of you who don't know what flash memory is in your iPhone or really any type of product right now with computer memory that doesn't spin. Obviously, if you're producing flash memory for iPhones, scale is the name of the game. You need to be a high production, low cost producer. However, InnoDisk operates in the niche space of providing very specific, high-end flash memory to very expensive industrial machinery. So in the case you were making a $1 million MRI machine, InnoDisk would be your solution provider for putting flash memory into your MRI. They've been growing for over 20 years, given the secular growth of memory in many different types of industrial machinery. And we would consider, then they'll have a nice secular tailwind of continuing to grow in this space. Given the fact that they operate in a niche, engineering-led universe, they're able to participate in this space, away from the commodity space, drive high returns and growth, and that translates to meaningful shareholder value over time. Management team's been in place for over 15 years here. The business tends to grow double digits every year. It's a capital-light business that earns high returns on capital, and it's trading for just over 10 times earnings, forward earnings. This is, again, another example of the type of businesses we can find today that provide high returns, growth, and a meaningful yield on its current valuation. Overall, this is what we're excited about our portfolio. When we look across our portfolio today, what we see is a portfolio trading at about 13 times earnings, that generates above 20% returns on equity with very little debt and should grow in the high single digits. We think this is an excellent time to put capital to work into the small cap universe because a collection of these types of businesses at these prices is fairly unusual. Thanks for joining me today. Please reach out to any of Pengana's distribution people if you have any questions about the fund. We'd be happy to get back to you and answer any questions you might have.